Hi, everyone, and welcome to SEG's live webinar discussion, Selling Your Software Company, Timing, Trends, and Market Dynamics. I'm Daniel Bowen, a Vice President at SEG. I'm so excited for our conversation today and want to say a special thanks to our guests for tuning in. The discussion should take about 45 minutes, after which we will answer a few questions from the audience. To submit a question, click on the Q&A button at the bottom of the Zoom app, and we will do our best to answer them during the Q&A portion of our webinar. With that, I'll hand it over to Austin. Take it away.
Thanks, Daniel. Hey, everybody. I'm Austin Hammer, a principal here with SEG, and I'm incredibly excited to be hosting this webinar today. I'm involved with both our deal execution and market research teams here with the firm, so I've got the privilege of being close to both individual transactions as well as broader market dynamics that are impacting our industry. In this session, we're going to discuss some of the key factors that impact the M&A process for a software company. In our work with founders and operators, a constant message that we hear is that there are few things more opaque for leaders than trying to understand and then subsequently strategize around a potential exit. This concern isn't misplaced. There are a dizzying number of considerations when pursuing an exit. Things like what type of buyer to partner with, how the economic environment impacts M&A, identifying the best timing for a liquidity event, and how to best optimize value are but a few factors that software leaders need to consider. When you throw in an uncertain market dynamic and a complex geopolitical backdrop, it can seem downright impossible. At SEG, we understand that it's an overwhelming amount of information to digest, and it's even harder to turn that information into an exit strategy. So our goal of this conversation is to make that process a bit easier. Whether you're an operator currently seeking a transaction or you're planning for an exit years down the line, we're going to hit the hot button items you need to be focused on to ensure that you create the best exit scenario for yourself and for your company. So with that, I want to go ahead and dive in. So we know you guys are all busy, and at SEG, we're a big fan of what we call caveman speak. We like to tell you what we're going to tell you, then we like to tell it to you, and then we'll tell you what we told you and make it as simple as possible to digest and walk away with some actionable insights from the webinar today. Our goals for the call are very simple. We want to share some insights into how the current market dynamics are impacting M&A. We want to talk about why for certain types of companies, it's a fantastic time to sell, and dive into what that type of company looks like from a profile perspective. We're going to provide some strategic guidance for companies that maybe don't look quite like that, and how they can then subsequently improve their profile for an M&A process. And we'll do all of this by sharing the framework that is our secret sauce at SEG that we've used for years to evaluate companies, which we call our 20 factors, so that you can all take home some insights into how to evaluate timing for your business and the valuation implications that impact the unique dynamics that every single business faces. So with that, we're going to start at a very high level and just hit some quick talking points about how the economy is impacting M&A markets today, and then we'll dive into a little bit about what that means for specific companies and how to think about it. So just starting at the highest macro level, you guys are operators and you see these dynamics play out on a day-to-day basis, but there are a few areas that I want to call out with regards to how we're seeing the economy and how it's impacting M&A. There's really two main factors. There's interest rates and there's growth. That's ultimately what all of the moving parts of the economy boil down to for a company. We all know that interest rates have risen. It's constantly in the headlines. People are talking about it, people are concerned about it, and it's really dominated a lot of the lexicon around economic markets and general business performance in the last 2 years or so. But there are two things specifically as it relates to interest rates that I want to highlight that we think about from an SEG perspective. The first is that the Federal Reserve has increased interest rates in recent years, and you can see that in the graph. They've gone up to 5%. Or north thereof from 0% in 2021 and 2022. And it's a little bit colored by recent years that this feels like a high interest rate environment because since the great financial crisis, we have been in the period of the lowest interest rates that we've ever seen. So recent times are not a great barometer for what typical interest rates look like. when you actually look historically back 20, 30 years, we're in a relatively low interest rate environment when we sit within that 5% range. The second piece that I want to talk about is the fact that interest rates have stabilized in the last 6 months. You can see from about July of 2023, they have been relatively flat. And that's because the Fed has stopped raising interest rates because inflation has responded really strongly to the initial rate hikes that they enacted. And so for now, they've paused future rate hikes, and there's even a possibility for cutting rates. This is, of course, incredibly welcome news to stocks, M&A markets, and businesses alike. The second vector I want to quickly talk about is growth. There's typically an inverse relationship between interest rates and growth. As interest rates rise, growth rates tend to decline. When you look at this graph on the right, which is a graph that's out of our annual report from our SEG SaaS index, which is the basket of publicly traded SaaS and software stocks that we track, we certainly see the dynamic of growth decline playing out, but it's more nuanced than just looking at a line that goes down. The graph on the right shows a few things. While growth has declined, I want to point out that the median company in the SaaS index is still growing quite well, over 16%. Considering the scale of these public companies that we track, this is actually a fantastic feat. The median index company added nearly $100 million of revenue to top line in 2023, which is by all means, and especially when you look across different industries outside of software, a phenomenal feat. The second piece is that smaller private SaaS companies tend to be less impacted by economic headwinds like interest rates. A lot of the companies that we work with and analyze at SEG saw incredibly strong performance in 2023 in spite of economic headwinds. And many of you listening are likely in a very similar boat. So what I wanted to simply paint with this slide is that at a topical level, it may seem like there's a doom and gloom scenario happening in the economy. But in reality, while there are some economic considerations, companies in the software and SaaS industries, both public and private, are continuing to perform at a really, really high clip and showing stellar results. So we would expect this strong performance, especially from the public company perspective, to show up in stocks, and we absolutely see it. Buoyed by a super resilient economy, as we can see, inflation was nearly halved. Unemployment remains super low, and US GDP grew a lot more than anticipated. It was expected to be flat and ended up growing in the 2 to 3% range. The SEG SaaS index grew 34% in 2023. So it was a fantastic year for the SaaS index. It outpaced the S&P and the Dow Jones and really trailed only the NASDAQ, which grew 43%. And in November and December, the SaaS index outpaced all of the other indices in the market by a significant amount. So this is great news for M&A markets because the saying goes that private markets tend to lag public markets by about 6 months, give or take, which means that M&A trends are due to catch up with this fantastic stock market performance at some point in the near future. This is why we refer to public markets as a leading indicator, if you will. The other thing is that this data only goes through December. If you've been paying attention to stock markets lately, you would see that the NASDAQ is touching record highs on a nearly daily basis, and that it's really, really strong performance across the stock market to start out 2024, which gives us and other market participants a ton of optimism for 2024 and the year to come for both public equities and for M&A markets. So then the question becomes, okay, this is great. What does it mean for M&A markets? Well, the first piece is that M&A markets were incredibly active in 2023. It was the second highest year on record, and it trailed only 2022, which was, of course, a record year at the time as well. So this to us signals that demand for these SaaS companies continues to be really strong from a buyer and investor perspective. And that's a thread that's going to continue through this entire conversation. The second is that while on the surface, M&A multiples have come down, there are some really fascinating trends that are happening a layer deeper. What I want to draw your attention to is this graph on the right, which shows that private M&A valuations, there is a gap between the median multiple and the average multiple. And so when we're building these reports and we dig a layer deeper and analyze the underlying data, what we see is that there's a high volume of lower multiple deals. So a lot of deals happening at low multiples. But then there's a smaller group of SaaS companies that are trading at well above the median, which brings the average up. And these are companies that are receiving premium multiples in the current market environment. So the two key takeaways are that demand remains really strong and robust, and that there's a certain collection of companies that are being rewarded with premium valuations in the current market. And so now I want to dive into what that means for you and your company as you think about valuation and timing implications. So what I want to talk about next is an annual survey that we release to buyers and investors and how it sets the stage to be a roadmap for any of the SaaS leaders on this call that are potentially considering an exit. Every year we conduct an annual survey. You can see my faces on it. Hopefully that looks familiar, where we ask and reach out to buyers and investors and go straight to the source on their current market thoughts. So regarding M&A, priorities when they're pursuing targets, and the key considerations that they're weighing as they go about looking to buy and invest in SaaS companies. In 2023, we received over 100 responses, and they yielded some super informative insights for us. The survey gave us a ton of color on the trends impacting M&A markets from the folks who are on the other side of the transaction. And that provides invaluable insights to SaaS operators who are considering an exit, so you can best position your business. So let's look at what our most recent 2023 survey yielded. So this is a fascinating graph. On the left here, you see that 3 out of every 4 buyers and investors told us that they were seeing a lower volume of high quality assets. That means that compared to 2022, 75% of buyers and investors are seeing less deals that get them really excited and less deals that they view as opportunities that they really want to lean in on from an M&A perspective. So lower supply of high quality companies. On the right side, we also see that 85% of investors and buyers told us that it's more competition for these high quality assets, right? So there's a lower supply of these assets, and as a result, there's a lot more competition in the M&A markets for the high quality assets. What I like to think about this as is a really simple example. You've got 100 people waiting in line for eggs, and there's 10 cartons of good eggs. It creates a highly competitive market for eggs. And so as a buyer of eggs, my main way to differentiate and make sure that I buy those eggs is I pay a higher price. And so when we talk about supply and demand in M&A terms, the trickle-down effect should happen in valuations. What's super fascinating is when we look at SEG's data in recent years and compare it against 2021, which for an M&A perspective was a bellwether year, we see some really, really interesting trends. SEG clients are seeing an average of more than double the IOIs or the first round bids that we receive in an M&A process than they did in 2021, which by many is considered the height of competitive tension within the M&A markets. So this is a staggering difference because 2021 in of itself was a fantastic year. And it reflects the exact dynamic buyers and investors is telling us are happening when it comes to an increased level of competition and interest. And we see that trickle down to valuations. On SEG's clients, we're seeing that valuations have actually increased since 2021 to the tune of nearly 50% on an average basis and 30% on the median basis. So while we see the broader market dynamics showing valuations declining, when we take a subset of those high quality assets, we're seeing that valuations have actually not only not declined, but actually increased a material amount since 2021, which was the record year at the time. So as a founder and an operator, I think this begs the question of, if we stick with the egg comparison, what does make a good carton of eggs? So we'll talk about that right here. This is exactly what we go on ask buyers and investors as part of our survey. We asked them the question of, can you describe to us in a free response format what buyers and investors are viewing as high quality opportunities? Tell us the way that you describe a high quality opportunity. Because this is exactly what we want to know at SEG, and as a buyer or as a software operator or CEO, it's exactly what you want to know as you're running your business. So let's go into some of the key buckets here. First of all, 70% of all buyers and investors told us that strong retention and mission critical applications are the major factors they're considering when viewing a high quality asset. And this is super important because it speaks to a trend that we've seen in recent years on particularly gross retention becoming critically important. We're going to talk about that a little bit more later, but gross retention has skyrocketed to the top of buyers and investors' minds because it is the best proxy for the durability and the sustainability of a business. We also see over 55% of buyers and investors mentioning solid fit or product. For strategic buyers, we're always going to see them place a value on the strategic fit. There needs to be synergies or a way for them to get into a new market or to supplement their existing product. But we also see a lot of investors talking about solid product because, again, in a less certain market environment, investors are looking for products that solve real pains with a robust functionality because that's table stakes for ensuring that the business that they're investing in is sustainable and durable. Another piece is profitability. This is critically important in the current markets. We are seeing that it's kind of a binary effect. And so what I mean by that is that for businesses burning cash, it's generally a challenge to pursue a liquidity event right now. On the flip side, a business that is generating some level of cash or break even, it doesn't have to be wildly profitable to transact. It's a sliding scale. Of course, the more profitability, the better. But as long as a business is break even or better, it's satisfying a key requirement for buyers and investors in today's market, which is that it's capital efficient and it has the ability to create cash. And then finally, growth. There's always an interplay in any single market cycle between profitability and growth. Growth will always, always, always be important in M&A. I hosted a panel discussion with some of the top software and SaaS PE investors last year, and one of them said something that has always stuck with me, which is that growth is the best predictor of growth. And I think that puts really simply what we're seeing, which is that growth is always a key consideration. But the main difference in the current market is that while growth is important, it is not at the expense of profitability. A few years back, growth at all costs was in vogue. It was not only getting deals done, but growing businesses that were burning cash were actually the sought after assets. Today, buyers and investors are looking for profitable growth. And so while growth is always going to be important, it will never be in the current market cycle at the expense of profitability. When we look at the year ahead, we expect these criteria to remain pretty similar for the buyers and investors as we think about our survey for this year. The one thing I think may change and that we want to call out is that we anticipate that as interest rates potentially continue to come down and markets maintain strong performance, growth will become more of a consideration for buyers. I think last year was a very sort of conservative year from the perspective of buyers and investors, hyper focusing on profitability and not being as concerned with growth. I think that growth will move up in the importance this year. But again, it's important to note that we don't think it will be at the expense of profitability. Profitable growth will continue to be a vector that buyers and investors are looking for when they think about high quality and attractive assets. So these are some of the criteria that we're hearing again from buyers and investors make a really high quality asset in the M&A markets today. I want to quickly tick through a few of the signs that we're seeing as we look to the public markets, because all of this kind of conversation around what makes a high quality asset has been through the lens of what we're seeing at SEG, what buyers and investors are telling us via the survey. And so a great litmus test for us is always, well, what does it look like in the public markets? So the first sign we see is when we look at the upper quartile of businesses in the SaaS index. So if we look at the top 25% of companies in the index, they are trading at a median multiple of 8.5x. That is a 50% premium over the regular or typical median multiple in the markets. And so this is fascinating because it shows that upper quartile businesses are receiving a premium valuation. When we look under the hood at what makes an upper quartile business against a median business, we want to call out two things. The first, look at that cash flow from operations margin. It's double for the upper quartile business. So the upper quartile businesses are 2 times as cash generative as the median business. They also are growing faster, 26% against 16%. So that is the first sign that when we look at the public markets, we are seeing this profitable growth dynamic play out. Again, there's a sliding scale for both, but the ability to grow and the ability to grow while generating profit is leading to outsized valuations in the public markets. Another way to slice it is looking at different buckets of growth and Rule of 40. And if anyone's not familiar, Rule of 40 is simply adding up ARR growth and revenue growth and EBITDA margin to create kind of a combined growth plus profitability metric. What's fascinating is that we see that businesses growing in the SaaS, in the SaaS index within the public markets at greater than 30% are being valued much higher. 9.7x, 10.9x versus below 30%. You see 7x on the left graph, 5.2x. The more you grow, the better, but growing more than 30% is creating really nice valuations in the public markets. But again, not at the expense of profitability. When we look at the Rule of 40 across the SaaS index, we see an even more staggering dynamic, which is that businesses in the SaaS index with the Rule of 30, greater than 30%, are receiving a really, really, really high premium compared to those less than 30%. The 30 to 40% buckets at 9.1x, the 40% buckets at 10.7x as of Q4, versus less than 30% is at 5.8x, and then less than 20, 3.7x. So this is another proof point that not just growth, but profitable growth are being valued, not just in private markets like buyers and investors are telling us, but in public markets. And then the last piece here, the more qualitative piece. We hear mission criticality, we hear retention. Well, a lot of public companies don't report retention data. So what we're able to do is use product category as a proxy for mission criticality. Not all product categories within the index are valued the same. So when we look at the broader index at a median of 5.8x, and then we pick a few categories that we view as mission critical. So think ERP and supply chain, security, given all of the rising threats as we enter a more technology-driven environment, and categories like DevOps and IT management that are experiencing a real run in light of the AI boom and the increased importance of having tools like that in a modern business. They're all valued higher than the median and are also either holding or increasing their value year over year. And so we're seeing this mission criticality from a product category standpoint play out as it relates to public market valuations too, just as we would see in the private markets. And so in summary, the exact criteria that we're saying defines a high quality opportunity in the private M&A markets are equally being reflected and rewarded in the public markets. Okay, so now we get to the fun part. We get to talk a little bit about the secret sauce, if you will, where we can dig into the nitty gritty and take all of this information that I've thrown at you from an economic and market and valuations perspective and distill it down into a useful way to apply it to each of your unique businesses. So what I want to walk you through today is what we call the SEG 20 factors and the SEG scorecard. This is sort of like I mentioned, it's our secret sauce. It's what we've been using for years to analyze software companies, to provide prescriptive feedback and guidance, to think about valuation, to think about market timing, to think about considerations. All of these things are guided off of our ability to leverage this framework to understand SaaS businesses. And it's something that has been incredibly valuable to operators. And so my hope is that in sharing this with you all, you can take it home and use it to work on your own businesses, or reach out to us and we can go through an exercise where we do a benchmarking analysis, or you fill out the scorecard and send it to us and I walk you through this criteria and give you an idea of how we view your business. And so how it really works is we take the 20 key factors that over the years we've identified comprise a SaaS business, both quantitative and qualitative. We use the data we've accumulated to create benchmarks for each of these criteria. And every time we look at a company, we score that company on each of these criteria against the benchmarks. The stronger the benchmark, the higher the associated valuation, and the lower the benchmark, the opposite. The result is a holistic view of a software business from several different functional aspects. And we visualize it in a way that can help us identify strengths and weaknesses and understand the unique dynamic impacting all sorts of SaaS businesses, and then ultimately provide guidance on valuation and timing. I think something else important to note is that each of these variables exist independently, but are interwoven together to tell the whole story of a business that enables us to help you understand how you can improve your profile, or if you score really well, some considerations on current market dynamics and timing. We also constantly leverage the latest market research to make sure that we're taking into account shifting trends or the weighting of these criteria, and that our scorecard and benchmarking framework is truly reflective of what buyers and investors are prioritizing. And so you'll see things like gross margin, rule of 40, are strongly weighted in our scorecard because it's exactly what we're hearing and seeing as we execute transactions on a day-to-day basis. And so what I'd like to do is take 3 to 4 examples here, a small handful of businesses, and show you all how we would interpret them using the scorecard frameworks, and hope that you can kind of hear how we create a narrative and talk about the story of businesses and take it back and apply it to your own business. So the first example here, this is a profile of a business that we see a lot. So let me tell you what jumps out at me when I look at this scorecard. The first thing I look at is it's incredibly sticky, 95% plus gross retention. So right out the bat, the highest weighted, most important metric that we're seeing in markets today, this business is knocking that out of the park. But you also look at this and you see a lot of yellow and a good amount of green. So you might be tempted to say, geez, I look at this, Austin, I think that a business that needs to go out to market needs to have a lot of green, or more green than this. And so I want to walk through this and see what's happening under the hood. It's incredibly sticky. It's super profitable, right? Rule of 30 to 40-ish business, not as high on the growth side. So right off the bat, I'm guessing that this is in some sort of esoteric vertical, like manufacturing or engineering. So picture it, a super complex end market with robust products and very specific use cases. Another piece of this scorecard that leads me to believe that that is indeed the case is I see 2 things. I see a lower gross margin in the 70 to 80%, which again is not a bad gross margin by any means for a SaaS business. And I see that paired with really, really high retention, makes me think that this is an involved implementation process that weighs down the gross margin a little bit, but that leads to incredibly sticky customers once the solution is implemented. Again, think software serving manufacturing or engineering capacities. That's not the only segment that exudes these types of qualities, but a tangible example. I also see customer concentration in 45 to 75%, which means their top 10 customers comprise anywhere from 40 to 70% of total ARR. Again, not a huge issue, but something that tells me that they probably are serving some really large enterprise manufacturing or engineering customers. And so the temptation might be here, hey, it's lower growth. I don't know if this is a great candidate in today's market. I would combat that by saying it hits a lot of the key buckets we're talking about, which is rule of 40, strong profitability, really good gross retention, sitting in a market that allows it to be super efficient and retain its customers. I also look at some of the qualitative factors, and I see hybrid. This is likely a business that's transforming from on-premise to the cloud, has seen some good traction with a legacy customer base, an associated uplift in ARR. And so there's a lot of potential for this business to continue to grow within its existing customer base simply by migrating customers. I see contracted recurring, I see highly differentiated, vertically focused, right? All of these things are things that I like when I look at a scorecard. So this business, while it might be tempting to look at it and say, it's only growing 10 to 20%, what we've seen and what we've heard from buyers and investors is that this is the type of business that could do very well in an M&A process today because it satisfies a lot of the criteria that we're hearing from buyers and investors are the most important considerations in the market today. Let's look at another one. This is a really good one, an interesting one. So let's imagine that this business is serving something less esoteric than manufacturing or engineering, like maybe something like a BI analytics provider that serves a handful of different verticals from enterprise to SMB, right? So again, still something that can be very sticky, right? As we see 90 to 95% gross retention. Something that is maybe a little bit less complex and esoteric than manufacturing, but that is still solving a real pain for its customers. But I also see a lot of yellow, and so I want to dig into what's happening here. The first thing that really pops out to me is, again, strong gross retention and better growth than the previous company. I also see that unit economics and logo retention are not as strong. LTV to CAC is in the 2 to 5x range. So a proxy for sales efficiency is scoring not as high. And logo retention is in the 70 to 80% range. And so this is a fascinating dynamic that we've seen before. When we see poor logo retention paired with really strong gross retention, mathematically what it means is that the company is churning a really large number of smaller customers, but retaining its largest customers. So on a logo or count basis, it's losing 20 to 30% of its customers each year. But on a dollars basis, it's losing less than 10% of its ARR. And when you see that the customer concentration is 20 to 45% and there's a low unit economics, it tells me that that's very likely what's happening here on the scorecard. I also see that it's pure cloud, it's recurring. Maybe it's a little bit less differentiated than a highly vertical niche manufacturing company, but it still has some good differentiation. So the question you might ask is, all right, Austin, well, what's this mean? What does this mean for my company? Is this a good time to go to market? What I would say is that there's two things to consider here. The first is that this business still qualifies as a business that could do well in the market today. It's got a lot of what we're looking for, right? It's not quite as profitable as the last business, but it satisfies that binary profitability. And it also has strong retention and Rule of 40. But there's a story here. It's churning a lot of small customers, and it's very likely spending sales and marketing dollars to acquire those customers that then turn around and churn. And that puts a damper on sales efficiency, which is why LTV to CAC is low. It also puts a damper on EBITDA margin because you're spending money on customers that are turning around and churning relatively quickly. So my advice to this type of business would be, it really depends on what you're looking like from a valuation perspective or looking for from an exit outcome and what you are thinking from a timing perspective. Because absolutely, it's a business that it can be attractive in the current markets with the right context, the right story, the right positioning, and the right understanding of the business. It's also a business that boosting valuation is not a super hard task with this business. It can stop selling to some of the smaller customers and logos, focus on its larger existing customers, and acquiring more logos that look like that, and then deprioritize smaller customers because they churn at a much higher clip. And we've seen this play out with customers or clients where we speak with them and they have this dynamic. They refocus go-to-market resources. All of a sudden, their efficiency gets much better. They become more profitable. Their gross retention improves because they're just churning less. And that logo retention starts to move up. And it moves up another turn or two on valuation just purely off of focusing on the right customers. So this is a really neat business. It's one that could do very well in the markets today, but with a few changes becomes an incredibly attractive business. Here's another really common profile. Growing super quickly, solid retention and gross margins, but there's some cash burn, and it's still approaching a scale where it really gets interesting from an M&A perspective at about $5 million. So I like to liken this one to something really disruptive, providing really modern technology in a slow to adopt vertical. So let's think something like, for this one, like legal technology, for example. Something that we see very often with businesses like this is that as they scale, they see strong growth rates. You're finding product market fit. You're working at law of small numbers. So, you move up from 2 to 3 million of ARR. You're growing 67% instead of moving 9 to 10 and growing at a lower clip. This business looks like it's invested a lot in sales and marketing because of the combination of cash burn and a lower LTV to CAC. But it hasn't quite reached the size where it's achieving some of the efficiency and the economies of scale that come with really realizing a sound investment in sales and marketing. So right now it's growing, but it's growing at the cost of efficiency and profitability. Again, we see this profile all the time, and it's a very common path to getting to 4, 5, 6 million of ARR. They find product market fit. They start to invest to go to market quite before they have the really key considerations that build a sustainable and fundamentally sound go-to-market motion figured out. The great news is that companies like this very often figure it out. You can scale the business, you get it to turn the corner on profitability because you get to that critical mass of customers where this net retention starts to compound, which they have greater than 100% net retention. So they're going to start to just, as the business grows, add more expansion. And their sales and marketing investments, as they bring on more of a critical mass of customers, are going to become more efficient. And that profitability is going to move from being cash burning to a positive profitability. And that scale is going to move from being sub 5 million to north of 5 million. And all of a sudden, a few key vertical or a few key variables and criteria change. And all of a sudden, you've got a fantastic M&A candidate. And so again, this is a business where we look at it and say, really unique business, neat business, one that has a lot of reasons to be excited about its future, but also is probably not a great candidate for an M&A or liquidity event right now because of its scale, but more importantly than its scale, because of its lack of profitability and its cash burn, which, as we've alluded to, has created this kind of binary dynamic in the current markets. And then this final one is this is one of my favorite profiles to talk about. And I'm passionate about it. I've written blogs on it. I've held or hosted other webinars on it. So it's a great case study. This business has excellent top-line metrics. It's growing healthy, it's profitable, it's got a rule of 40, really good scale, solid net retention, right? North of 110%, best-in-class net retention. But when you dig a layer deeper, there's one metric here that sticks out as something that's problematic. And it's that gross revenue retention in the 80 to 90% range. Again, in a vacuum, 80 to 90% gross retention, depending on end market, size of customers, what have you, is not necessarily a challenge. But let's pretend that this is a business that's serving larger customers and having some challenges with churn. When we dig a layer deeper, this is one that I refer to and we at SEG refer to as the leaky boat, because you've got holes in a boat, and to keep yourself from sinking, you've got to keep filling the boat with water. It's at scale, so this business is clearly incredibly good at selling its product. It's got that high net retention. It's growing like a weed, so it's successful at upselling its existing customers, but it's also equally strong at acquiring new customers. And the inherent challenge with this business is that it has to be good at selling because of its gross retention. Let's assume its gross retention is 80%. Every year, it's got to make up for losing 20% of its revenue because it experiences a lot of loss from downsell. If it can't make this up, it's a business that can be flat or low growth or shrink. And so I mentioned earlier in the conversation that we've seen this shift from net retention. Years ago, 2020, 2021, it was all about net retention, net retention, net retention. We even hosted a webinar where we talked about the compounding effects of net retention. The current markets, as I've alluded to, have seen a shift towards gross retention, and this type of profile is exactly why. Buyers and investors are going to have concerns about the sustainability and the durability of a business like this, and it's going to impact the potential valuation because of the dynamic that if it's looking to, M&A ultimately is not venture capital. There's a level of conservatism as they're underwriting deals. And so if there's concern that economic headwinds result in budgets tightening and sales cycles elongating, then there's a chance that they can't hit that north of 110% net retention. And they can't keep adding X number of new customers per year. And so all of a sudden, that leaky boat puts a damper on growth. And now you're losing customers, profitability takes a hit, growth takes a hit, and gross retention remains a challenge. The flip side is that the good news is that we're improving retention for this business profile, which we have seen play out again and again and again in our time at SEG, can have really, really strong and immediate impacts on valuation. If you just assume that this is like a $10 million ARR business, for example, and it moves gross retention from 80% to 90%, in the first year, it's going to add $1 million of ARR by simply retaining more customers, right? Over a 3 to 5 year period, not only is it going to be a larger business as it grows more off of bigger numbers, it's going to have stronger gross retention, stronger net retention, faster growth, and a sort of compounding impact of keeping its customers at a higher clip. So what it means is that 3 to 5 years down the line, this is a completely different business. And it receives a different M&A multiple, right? If this business, just throwing arbitrary numbers out there, trades at a 5x, 4x today because of its gross retention issue, it can trade a couple years down the line at a 6, 7, 8x and be a business that is fundamentally different simply by moving its gross retention from 80 to 90%. So when you think about a larger business at a higher multiple, you're talking tens of millions, 30, 40, $50 million of value that's unlocked in an exit scenario simply by prioritizing gross retention. And I hosted a webinar with some go-to-market experts last year where one of these experts shared this exact situation. She was out of business. They took on a PE investment. She worked with that PE firm to identify the fact that they were spending time on customers that were ultimately dragging down their gross retention. They did a minor shift and pivot into focusing on higher value customers and letting some of the problem customers and less profitable customers churn. And then as a result, turned that into tremendous value creation. And so it's a very common story in SaaS, and it underpins exactly why a lot of buyers and investors have pivoted from net retention to gross retention. Again, net retention is still really important. You can show 110% net retention. That's fantastic. But in a very similar way that growth is growth, but not at the expense of profitability, net retention, but not at the expense of gross retention. And so this is another one of those profiles where it's a fantastic business. And with a little bit of movement on these key metrics, it can become a stellar high quality business from an exit scenario perspective. So if you're listening in on this call and you find yourself in the bucket of one of these businesses that it's a great time to go to market, that's fantastic. And we would love to have a conversation with you and flesh out timing. If you find yourself saying, yeah, Austin, I've got a couple of these metrics where you're going to tell me it's not quite as good. I still want to have a conversation. I want to look at that scorecard. I want to interpret it. My hope coming out of this call is that you all go on our website, find our scorecard, fill it out, and reach out to me and ask me to walk through it with you or interpret it. Or we can simply undergo a strategic assessment and do a benchmarking. But if you are one of these businesses where you're seeing some of these metrics and you're going, I want to pursue an M&A event, but now I'm hearing this and I don't know if now's a good time. What can I do to improve my business? Here's a few starting points. So when we think about retention challenges, there's a few critical areas that companies we see often overlook from a retention perspective. So many folks think about retention from a product perspective. My product is not there. I need to improve my product. I need to find a way to more highly differentiate it. And while that can be true, it's just as often, if not more so, a function of go-to-market strategy. In that example I shared with you previously on the go-to-market expert I talked to, she talked about focusing to selling on the right customers that are the best fit. Not just to sell, but to sell to the right customers so that when you spend money on the sales and marketing process, you grab a customer that's going to be a really good customer and grow with the business. And the best way to do this is by spending time with your best customers and prioritizing their needs. Listen to those customers, understand their needs. What do they love about your product? Why are your power users championing your product? Another way to do this is perform a really deep analysis to determine those highest value customers. So segment and slice your customer base every way you can. Tenure, vertical, size. Are they enterprise? Are they SMB? Lead source, right? Who you're selling to. Do you have better success when you sell to a C-suite executive versus someone that's lower level, right? Try to parse your customer base in every way possible, because what it will allow you to do is tell you the best bang for your buck in your customer base. And then you can go ahead and devote efforts there, both on retaining existing customers from a customer success standpoint and addressing it from a go-to-market standpoint and making sure that your sales reps and your marketing is all tailored towards your highest value customers. That itself is going to likely result in tremendous value added just by improving retention. And yes, if there are product gaps, when you hear from your customers, create a plan to address those. Another very common one that you can see again is cash burn. If you're saying, Austin, I've got all these metrics, I'm just short on the cash burn piece. What we want to do is plot a path to profitability. Focus on sales efficiency, create strong unit economics, remain laser focused on those highest value ideal customers to continue that growth with more efficient spend. A really easy way to do this is split out hunters and farmers. All the go-to-market experts we talk to they sing from the mountaintops that this is the easiest way to improve efficiency and trickle down that efficiency to profitability. Because new customers are completely different than existing customers. The sales process is different. The dynamic of Finding customers and listening to them is different. And so that's a really easy way to not just help cash burn, it also trickles down to helping growth on the line below. And then consider cost structure, right? There's always spend ahead of the curve, but if you're looking to do a liquidity event in the near term, deprioritize investments that are not generating revenue in lieu of allocating spend on areas that can have near-term impacts to growth and revenue. And the last piece I'll say is that a lot of customers or companies are saying, hey, we get you, but we're thinking 3 to 5 years down the line, and right now we're focused on growth. So we need to burn cash to reach that growth. And I'll say that's great. We always just say burn with a purpose. Monitor your cash runway. Focus on knowing how to become profitable when the time comes and the specific knobs you're going to be able to turn from a spend perspective or a revenue perspective or a synergies and efficiencies perspective to ensure that you're plotting a manageable path to profitability. And then the last piece, grow from within. Work on, if you're struggling with growth, you're super profitable, you're super sticky, grow from within. Work on growing existing flagship customers. Understand what product capabilities you can add to make sure that you can cross-sell to existing customers at a higher clip. Think about breaking out the sales team, as I mentioned, between hunters and farmers. Reinvest the profits that you have back into the business and focus on finding ways to pick the lowest hanging fruit to grow from the tree. Oftentimes the temptation is go into a new vertical, go into a new market, try to find new ways to acquire new customers. Very often, the answer to more growth exists within our strongest customers. And you can always diversify sales channels too. Options like referral programs, partnerships, resellers, right? There are other ways to supercharge growth that don't require you to completely reinvent the wheel in the way that you currently grow. So the last few closing notes here, and then I want to open it up to some Q&A for the next 10 minutes or so of the webinar. The US economy is really, really strong. SaaS and software companies are a fundamental part of that ecosystem, right? So there is a lot of reason to be optimistic this year from an economic perspective, from an operations perspective, from a general markets perspective, because the trends are looking good and software and SaaS are entrenched as a key part of that backbone. Public software stocks are continuing to perform very strongly. The M&A markets are active. And businesses with the right profile are seeing outsized interest in valuations. And so the question becomes, if you're considering an event, do you fit that profile? If you do, fantastic. And if you don't, the great news is there's plenty of ways to improve that profile. And that's what I really want to underscore here. We are here to help. We love to be a sounding board. We want to be a mentor. We want to help our valued SaaS ecosystem continue to improve their outlook from an M&A perspective. And so feel free to reach out. I'd be happy to do a scorecard analysis, a benchmarking analysis, whatever we can do to help you as an entrepreneur and operator are going through your journey. We want to make sure that we're here and we're ready to help. And so with that, we've got some Q&A in from the crowd that I would love to hit from the next 10 minutes, and then we'll wrap up. Okay, so first question I am seeing here is a really good one. So I don't have any of the challenges that you are mentioning with my business, but I'm still a few years away from wanting to pursue a liquidity event. What do I do in lieu of some of the metrics you talked about to make sure that I've got the right mindset? Okay, this is really interesting. So this business is already in a good position, but it wants to do more. What can it do? Some basic table stakes for preparing for an M&A transaction. One, get your data in order. You always want to have clean data, customer base, MRR sheets, really clear handle on your financial controls, the way that you look at customers, the way that you're analyzing your customer base and your company. Data is paramount in an M&A transaction, and the sooner you get to clean that up, the better. The second thing we always talk about is legal cleanup. A lot of folks overlook legal cleanup. The ability to get your house in order, think about organizational documents, think about customer contracts, think about important events in the founding of your company and the different lifestyle or the different life cycles that your customer or your company has faced in its growth. You want to make sure that you have the right legal documentation because that can be a real pain come the diligence process. And then the third piece is think about your team. a lot of folks overlook the fact that a strong team is critically important in M&A in this lower middle market that we inhabit. Because ultimately buyers and investors are buying companies, and companies are people and teams. And so think about a way to elevate your team and work with them to be as strong as possible, fill out any gaps that might exist on the management team, and elevate the folks that are really strong and high performing on your team to make sure that they've got real opportunities to continue to be a part of the business, because that will help you a lot in M&A. Let's look at another one. How does company size impact everything you were saying? ARR, total revenue, less than 10 million, 10 to 50 million. Great question. So we've done the analysis, and roughly speaking, this is not the gospel, but a rule of thumb. Every time you go up 5 million or so of revenue, right? So 5 million of ARR to 10 million, 10 to 15, 15 to 20. As it gets higher, that band probably goes from maybe instead of 5 million to 10 million. So instead of a $20 million, $30 million business, right? But as you move up, you can usually assume a multiple expansion of somewhere in the neighborhood of 10 to 20%, simply by getting larger. And so the sliding scale, if you will, on the size of businesses is roughly to the tune of 10 to 20% bump as businesses increase in scale. Now, that doesn't mean that smaller businesses in a vacuum cannot achieve high outcomes. We see it all the time. It just means that if you give me a business that all other metrics are equal, the more that you are larger on each of those bands, you can expect about a 10 to 20% uplift in valuation. Would you consider an ARR in the range of 1 to 3 million too low for most M&A transactions? This is another great question. So dovetailing off of that size question. Typically, we see the current M&A markets, M&A start to be really interesting for businesses at about 4 to 5 million of ARR. But I think it's really important to note is that this has come down. 5, 10 years ago, when SaaS M&A really was in its nascent stages, buyers and investors would not come down to below, call it 15 million. They need to see real scale. Then it moved down to 10 million. Now we're seeing it move down from 10 million to the $5 to $10 million range. And even some looking at 4 to 5 million. The challenge with the business in the 1 to 3 million ARR range is that it tends to still be a little bit too small to get private equity investors interested at a critical mass, which makes it a challenge to generate competitive tension in the M&A process, right? When you're in that size range, what you're really depending on, again, outside of edge cases, is a strategic buyer having a really, really strong product need. Again, we see that happen all the time. There's a long tail in this business, and there's a lot of businesses that trade from a $1 to $3 million ARR. However, it's usually a strategic relationship that existed or an inbound. It gets harder to rationalize running a full M&A process in that range because of the fact that you don't have that critical mass of private equity buyers driving competitive tension to really find a way to maximize valuation. That being said, doesn't mean it can't happen, especially if there's high strategic rationale, but we see it less from making sense from a rational M&A process perspective. However, if you're at 2 to 3 million and you're going to 4 to 5 million and you're proving out your pipeline and you're growing on a quarterly basis, simple micro pivots to achieve that scale can absolutely have very real effects on the feasibility of the M&A process. So I'd say if you're 2, 3 million, approaching 4 or 5 million, and you're starting to think about M&A, it's never too early to start having a conversation with folks like ourselves to make sure you're thinking about it properly, because a couple customers, a couple contracts, a couple quarters can tip the needle from being an iffy candidate to run a full-on M&A process to a really strong candidate. Okay, last question here. Are any high multiples happening today, mostly strategic software buyers because they have the product needed? Oh, that's a great question. There's a massive market perception that strategic buyers are the best buyers to place an outsized strategic multiple. And all else equal, that will always be the case because strategic buyers have synergies, they have product needs, right? However, we have seen private equity become incredibly more active and almost reach valuation parity with strategics in recent years. And the reason is because of this competitive dynamic and because of the absolute feeding frenzy that's been happening from investor perspective. software M&A has seen such a robust growth, as you saw on the volume slide, partially driven by the fact that private equity has now had capital earmarked for software. And so about 60% of all M&A deals are happening today that, being backed by private equity, whether it's a straight platform investment or whether it is a strategically, private equity portfolio company. So there is a lot of valuation parity now. Again, all else equal, a strategic buyer, if it's got all the right synergies, if it's got all the right knobs it can turn when it buys a software company and it creates product overlap and cross-sell opportunity and cost synergies and all that good stuff, they're going to be able to pay a higher multiple. But in the absence of that kind of perfect scenario, we are seeing private equity be at very close valuation parity to strategic buyers because of the fact that the asset class has matured so much as it relates to investing and buying software companies. So great question. We see multiples come in strong from both types of buyers. Okay, so we're at about 5 till the top of the hour. So I think that's all we've got time for today. I want to mention, if we didn't get to your question, we will be sure to reach out and get any unresolved questions answered offline. And again, I am more than happy to hop on the phone with anybody on this call and talk further, answer questions, and dive into how these things may be impacting your business. I want to express my excitement for the year to come, as it's looking like 2024 is going to be another really strong year for SaaS M&A and SaaS businesses. I also want to extend an immense gratitude to our attendees. We really value your engagement every single time we have these webinars, and your active participation through the webinar via the Q&A. We hope you gained some real insights today and have some takeaways that you can bring back to your decision to make or your business to make decisions that align with your exit goals. And as always, feel free to reach out with any questions. Thank you. I'm immensely grateful for the time. And I'll go ahead and pass it back to Daniel now for closing comments.
Thanks, Austin. For those of you still on, a survey will appear as you leave the webinar where you will have the opportunity to submit any additional questions. Feel free to take a few minutes to fill it out, and we'll do our best to send a response as quickly as possible. We will also be emailing a recording of today's discussion, so please be on the lookout for it. Thanks again, and I hope you have a great week.